And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, second best day of the week, and that also means that Michael Lebowitz joins us this morning to talk a little bit about economics. We've got a Fed meeting coming up next week. We've got a lot of stuff going on, so a lot of stuff for him and I to get into today in today's edition of the Think Tank. So appreciate y'all joining us this morning. Be sure to like and subscribe to the channel while you're here. We certainly appreciate that very much. Again, we're still lacking a lot of economic data from the government, so we have to kind of rely on some other data that is out there to try to figure out where the economy is right now. And a lot of that data right now continuing to show that the economy is slowing down, right? That we're seeing some weaker economic data. Certainly have seen some concerns lately from things like Tricolor. There's another subprime auto lender that's filing for bankruptcy now. So we're starting to see that stress, particularly in the lower end of the economy, and that's starting to feed through. And so looking at things like the new orders index, the ISM new orders index, that's certainly been stronger as of late, but the market's grossly outperforming that index, right? So when we take a look at the actual strength of new orders, the markets are far outperforming what that new order index actually looks like. The Chicago Fed produces a chart of hiring expectations for the next year. That is now at the lowest level since the pandemic. So what does that all say? It all suggests that the economy is a bit weaker than expected and that consumers are, slowing down here a bit. And again, we're still missing a lot of retail sales data, that type of stuff that we'll get after the government reopens. But some of these kind of other indicators do suggest the economy is weaker. Now, that does not mean recessionary, right? I don't want you to say, oh my gosh, we're about to go into recession. That's not what that's saying at all. But what it is suggesting is that the actual growth of the economy, which is where earnings are derived from, may be a bit weaker than what markets are currently expecting. So when you take a look at what markets are expecting in terms of earnings outlook, earnings growth rates, those type of things, those forward expectations are very, very high. We currently have the largest deviation in earnings expectations from the long-term growth trend of earnings ever on record. So again, just a lot of optimism in the market, but that's not surprising, right? The last time we saw, this type of, kind of outlook for the market, for instance, the JP Morgan Froth Sentiment Index is now at the highest level since the dot-com crisis. So again, just a very optimistic market. And again, as we kind of see at every turn so far anyway, we've seen investors come in to buy the dip, right? Every time we have a sell-off, investors have been stepping in, buying that dip, kind of regardless of the risk. And they're buying some of the more risky assets that we've seen, the stocks without fundamentals, stocks with just kind of speculative hopes of the future. That's been the big drivers. Today, Michael Lebowitz noted in our daily market commentary talking about Beyond Meat, which has had a huge surge here over the last couple of days, up a couple 100%. And this is a company that was literally on the verge of bankruptcy it really hasn't changed. Their fundamentals haven't changed. This company has not made money ever since its IPO, but investors are chasing this, right? It's just, we're seeing this continued push and things like the most shorted stocks, those type of things. That's what's happening in the markets, right? Still just a lot of that very bullish, optimistic sentiment. Nothing wrong with that. It's being done on leverage. That's a problem. In fact, that's going to be the subject of this weekend's Bull Bear Report, is talking about the leverage in the markets and kind of how that works and the risk that investors are taking on. So we're going to cover that in more detail in the Bull Bear Report this weekend. So make sure you're subscribed. If you go to the website, you can subscribe to the newsletter. We email it out to you every weekend, so you'll have that. We have lots of market statistics and analysis in that as well. Our fear-greed gauge, our technical indicators, all that's in there for you to help you manage your own portfolio better. Okay, but having said all that, let's talk about what happened in the market yesterday and some of the other things that are going on in the markets here. So here's what you need to know before the bell this morning. So let's start with real quick, just talking about the big news of the day right now, which is oil prices. Oil prices having a very sharp jump this morning as the Trump administration imposes new sanctions on Russia in terms of oil. So that's causing a nice big pop in oil prices. We've talked about the fact before that oil prices have been very, very oversold. Energy stocks have been lagging this year to a large degree, and it was just kind of a function of time till we start to see a bit of rotation in the markets, and we're certainly seeing that here over the last couple of days. Big jump in oil prices. We're triggering a very, very low MACD buy signal, so this may actually have some legs to it. Energy stocks are going to perform fairly well this morning. ExxonMobil's up 1.5% here at kind of pre-market. Those stocks now, interestingly enough, energy stocks have not performed as poorly as oil prices, which is one dichotomy that is certainly worth worrying about. And the question has been will energy stocks catch down with oil prices? Will oil prices catch up with energy stocks? Well, right now we're seeing energy prices starting to catch up with energy stocks. So we'll see how this kind of plays out. But again, this has been worth noting. Now, here's the important thing. This is going to go to a conversation Mike and I are having this morning about the dollar. The oil trades in dollars around the world. So if I'm buying oil, I'm buying it in dollars. So again, I've got to trade oil in dollars. And this is kind of one of the problematic cases of the whole debasement narrative. But we're starting to see a rotation back into U.S. assets, and particularly dollar-denominated ones. So pay attention to oil prices. That's going to be an important play here, at least near term, particularly if this rhetoric with Russia, between Russia and Ukraine, ramps up. Keep a watch on oil prices. Maybe some decent opportunity there. Let's talk about the market itself yesterday. So good news, bad news in the markets yesterday. So first of all, the market did sell off a bit yesterday, and that's okay. We're coming down, retesting the 20-day moving average. Now, the good news, I said it was good news, bad news. Here's the good news. Good news is market has had, after testing the 50-day moving average on that 2 Fridays, or Friday before last, we came down and we've now kind of stair-stepped back above the 20-day moving average. Yesterday, we came down, touched the 20-day moving average, rallied off of that yesterday, and kind of held support right there at the 20-day by the close. So again, that's the good news. The not so good news is that there's a rising bullish trend line that's running right along this bottom. Now, this bullish trend line has been intact really for the last several months. We broke that Friday before last, and now have failed after testing the bottom of that rising trend line yesterday. So again, we're kind of in a real key juncture here. The market's kind of struggling for air here. We need to keep this, the market needs to get back above that rising trend line from those lows to keep this bullish trend intact. If we fell here and then come down and retest and fell at the 50-day, we're gonna have a bigger correction in the markets. Now, I don't expect that to happen right now. The kind of the trend of the markets and kind of where we are suggests that we're going to try to kind of hold above this 20-day moving average. The markets are looking to kind of open flattish this morning. We'll see if we get some push through. But again, this is the kind of thing that we were talking about. But now, however, this is a bit of a dichotomy of what's happening in the markets right now. This is a function of, over the last couple of days, this kind of sloppiness in the market is a function of large cap stocks holding up the overall market. If we dig down just a smidge, momentum has actually been just crushed over the last few days in particular. But yesterday small caps were the worst performer that we saw yesterday, and over the last couple of weeks they've been some of the worst performers as well. So, but in particular, some of these momentum stocks, stocks that have been the bigger chasers, have had very, very big drawbacks over the last 2 days in particular. And we've warned about taking profits, rebalancing risk, particularly in those areas of the markets, because that's where when there's a rotation in the markets, that's where they get hit the hardest. So funds like the ARK Innovation Fund has been hit really, really hard the last couple of days, much harder than the overall market. So again, it's always about measuring and monitoring your risk in your portfolio. If you're chasing a lot of risk, be aware of big drawdowns when they occur, because they can occur very, very quickly, particularly when they're on leverage. All right, that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Lebowitz. We're going to talk a little bit about debasement. We're going to talk about the Fed meeting coming up next week. Got a lot of stuff to get into on today's edition of The Think Tank. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb miss that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Rhett, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Wow, it's really loud this morning in my ear. Got it. I'm deaf. Good morning. Welcome back to the show. Of course, it is the Think Tank edition of the Real Investment Show today. Let me know in the chat how you enjoyed that conversation with Ben Grand yesterday. We did kind of a deep dive into, managing money for kids, those type of things. So let me know. We've got a lot more interviews coming up. We've got Thomas Thornton on the horizon, Doug Cass. Got some good interviews coming up for you guys. So again, we'll have those interviews out as we get them done. And I hope you enjoy those. So a couple of things, as I said, and Michael's joining me this morning. So one of the things that we've got coming up tomorrow is the release of the CPI report. So, the inflation report has been furloughed along with the rest of the government because of the government shutdown. We've not been getting any economic data. Well, they're going to release that data tomorrow, which is important because we have the Fed meeting coming up next week. So the big kind of question right now is like, oh my gosh, is the CPI report going to show a big surge in inflation over the last month or so since we've had the last report, and tariffs finally making their impact, or is it going to show us something else? We're going to see that continued trend of kind of disinflation, in the report tomorrow. I think expectations right now, Mike, are for 0.4, if I'm not mistaken, a 0.4% increase tomorrow.
They're kind of 0.3, 0.4, but in that range, depending on who you look at.
Gotcha. And of course, this is important because this report's coming out tomorrow, and then the Fed meeting for the next rate cut, which it's highly expected right now the Fed will cut rates by another 25 basis points, is next Wednesday. It's the actual meeting date. So, Mike, kind of what are your thoughts here? I mean, if looking at some of the data, kind of the anecdotal, kind of real-time data, are you seeing any change that might suggest a stronger inflation report tomorrow?
Month to month, it's really hard to know whether it'll be a 10th stronger or a 10th weaker, because that's the way these reports tend to be. If we look at Trueflation, so that's a private, independent inflation gauge, I think they use like 30 million price inputs. It's much more robust than CPI. That has really been waffling between 2 and 2.25 since about April or May. And that hasn't shown any signs of picking up or slowing down. It's just kind of been where it's at. That leads me to believe inflation will be 0.3, maybe 0.4 if it's high, 0.2 if it's low. Inflation expectations have actually been working lower. So the market, this is market-based, based on TIPS and U.S. Treasury bonds, that's been working lower over the last couple months as the market senses slowing economic activity. So, for what that's worth, that says there's a bias towards the lower side. And then a lot of these sentiment gauges, University of Michigan, ISM, the manufacturing and service surveys, are all telling you that inflation expectations are high, but they haven't risen recently, and some of them are starting to come off a little. So again, 0.3, 0.4. It's delayed, so the question will be, even if it's a surprise to the upside or downside, will the market put as much stock into it as it would have if it came out 2 weeks ago?
Well, again, I think the one thing you didn't touch on was the homeowners equivalent rent or rental indexes. Right. If you look at the real time rental indexes and kind of what's going on with home prices, which again, that's the biggest input into CPI. That's 44% of the whole index. Are you seeing any pickups and any house price increases or kind of rental increases?
It doesn't matter because the CPI index is looking back a year and a half, 2 years ago. So we have our crystal ball into what that is going to be. So to answer your question, no, OER should, if anything, surprise inflation to the downside. That's 40% of inflation. So, forgetting everything else, just based on OER, I would say that the odds of a surprise are lower, not higher. And to your question, no, chiller prices, home prices are flat to coming down. Rental prices are coming down relatively quickly. So that's future inflation as reported by CPI that should keep a downward pressure on CPI, but that's down the road.
Yeah. Well, with 10-year yields now back below 4% and we're at 3.95 today, I think yields are down a little bit more. Yields are down a little bit more this morning. Part of that, kind of that calculation we've talked about before is economic growth and inflation, and they kind of suggest that the bond market's expecting at least kind of a continued pace of not a drop in inflation, like you're getting into a recession, but kind of that continued grind lower in the rate of inflation over time as economic data is showing signs of slowing. I was just talking about this morning, the Chicago Fed. Liz Ann Saunders had a really good chart out this morning showing the Chicago Fed, which produces a hiring expectations for next year or a year forward, and that's at the lowest level since the pandemic. So again, when you start talking about hiring, you start talking about what's happening in the economy, there's lots of anecdotal indicators that suggest the economy is not falling off a cliff, but it's certainly slowing down. And if it is slowing down, that's going to drag the rate of inflation lower because inflation comes from supply and demand within the economy. And if consumers are not consuming as much, you're going to have a slower rate of economic growth. And it's kind of maybe what yields are starting to tell us as well. Is that what the bond market's expecting?
Yeah, I think it's a really tough situation here. I could go on for 10 minutes here and tell you why I think we're heading into a recession. And then you could have me back tomorrow and I could spend 10, 20 minutes telling you why I think the economy is just fine and will do well. And, in the media, you have people that are bearish, people that are bullish on the economy, and they're all espousing their thoughts. And there's logic to all of it. So, the economy has shown signs of slowing, but it hasn't shown signs of recession. It hasn't shown signs of booming. So I think what the bond market is reacting to is some of that slowness, but also the fact that tariffs that were so greatly feared aren't leaking into the economy. It's I think it's more, Lance, that term premium, which was again based on inflation and fiscal deficits, that fear is fading. So that premium is coming out of the market, coupled with a little bit of slowness in the economy and concerns about the employment market.
So, yeah, and that's kind of the challenge here, because again, when managing money, right, is we've got to manage for money of what's happening today, and of course this market's been really kind of easy. You just kind of throw money in it and it goes up, and it really doesn't matter. But the problem is that the markets are eventually going to start pricing off on some of this reality. Again, expectations right now, as I mentioned at the beginning of the show, earnings expectations are still very elevated. We're still expecting very strong earnings growth rates next year. Those earnings have to come from somewhere. And what's interesting is that the earnings expectations for next year is very different than it's been for the last couple of years. Over the last couple of years, the earnings growth was expected to come from basically the Mag 7, and small and mid caps weren't expected to provide much contribution to those overall earnings growth during the last couple of years. But that was when we had really, really strong economic growth. Now we're seeing economic growth slowing, and it's expected next year that small and mid caps are going to have this boomer recovery in earnings growth, and the Mag 7 that are doing all of the AI build out are actually going to have closer to single-digit earnings growth next year. So it's kind of a really interesting dichotomy here that all of a sudden, small and mid caps, which are very economically sensitive, are expected to have this boomer earnings growth at the same time we're watching the economy slow down. And that's where I think the risk problem comes in for next year is if earnings don't meet expectations, the revaluation of the market could be pretty sharp.
which is kind of funny. It's telling you that the equity analysts at JP Morgan, at Goldman Sachs, et cetera, think the economy is going to accelerate. Yet their economists and their bond traders are telling you, no, it's not.
Right. That's the hard part.
Good luck with that one.
Exactly. So,
And by the way,
Yeah.
Lance, they're all selling something. So just understand what they're selling and then take their advice.
Yes, they are selling, as we were talking about yesterday on the show, and as you touched on in our daily market commentary, they're selling 5 times leverage now in ETFs. So that's what they're selling. Right.
Exactly.
By the way, if you didn't read our daily market commentary of the last 2 days, on Tuesday and Wednesday, and again, I'm going to touch a little bit more on this weekend's newsletter, but Mike and I both wrote pieces talking about the leverage increase in the markets, and what's fascinating right now is that 2x and 3x leverage wasn't enough. We're now getting into 5x leverage. And what investors don't realize about 5x leverage is that in an environment where you potentially lose 5% in a day, which can happen, that ETF can go to zero because of the leverage that's inside of it. So there's a lot of risk being applied to the market through these ETFs. There was recently just a Granite Shares ETF. They sent out a notice to all of their investors, and this was one that was based on AMD. It was an AMD short leveraged ETF. AMD did the deal with OpenAI. The stock shot up like 20%, and Granite Shares sent out a letter to all their investors saying that the value of their ETF is now 0.0000. They had to go out to 4 digits to show there was no value in this ETF. Completely wiped you out. That's the problem with leverage. So if you're trading leverage through ETFs, that's okay. I mean, a lot of investors are jumping in the markets right now going, I just want all the gains that I can get. That's okay. Just remember that the edge that cuts you the deepest with leverage. And that's because when leverage works in reverse, it's twice as bad as it is on the upside because of the forced unwinding that occurs when that leverage happens. So again, as you know, kind of Mike points out, there's a lot of expectations for markets going into next year. And there's right now a lot of sentiment froth in the markets. We're seeing a lot of speculative activity, and Wall Street is happy to provide you with what you want. If you want leverage, Wall Street is going to provide you leverage. And if we keep going, we're going to get 10 times leverage ETFs at some point. Somebody will figure that one out and sell you 10x leverage. But the problem is that when this market corrects, that leverage is going to get wiped out really quickly and take you along with it if you're not careful. So again, just word of warning. Go ahead, Mike.
And Wall Street's also making this leverage nice and clean. You can just buy an ETF. You don't have to take out a margin loan or get the leverage in some other way. So I think for lesser experienced retail investors, it hides some of the risk because you're just buying an ETF. It's easy. And when you're talking about like 5 times levered or even more, I think it's more akin to sports betting than it is investing at that point, because you're really just betting on what's going to happen in a very, very short term. You know, what's going to happen in the market in the next day is a coin toss. What's going to happen over the next 10 years? We can have a good debate about what returns should look like and why. But the shorter time frames are all, you know, become very random. And when you apply that much leverage, you are, you know, to some degree making a all or none type of bet like sports.
Yeah, so, but don't be mistaken, Mike. You said that, you know, Wall Street's providing a clean way to do this, to take on leverage without having to take out margin debt. Don't be mistaken about that. We've had the sharpest increase in margin debt over the last 5 months that we've had since 2021. And margin debt right now is well over $1 trillion. It's the highest levels on record we've ever had. I'm touching on this a little bit in our comments this weekend, but you take a look at what's going on what we're seeing is investors not only taking on 5x leverage through an ETF, they're doing it on margin as well. So they're margining the leverage on top of that. So, you know, the risk of the blow up is going to be quite dramatic and look, it may never occur, right? This time may be different. I wouldn't bet on it, but, you know, historically says that when these things reverse, the damage is pretty violent.
and what's the common denominator between whether it's a nice, cleanly packaged ETF with leverage or a margin or someone actually borrowing from a bank and investing it. It's liquidity.
Right.
And, we've written twice about this in the last week or so. Liquidity is showing signs that it is drying up a little. I'm not saying problematic, but there are signs that liquidity is tightening. We know the Fed is still doing QT. So, you have to be careful that, remember what happened in the alt cryptocurrency coins, what was that, 2 weeks ago?
Right.
Liquidity just dried up completely, and a lot of those coins went to zero.
Right.
So, not saying that stocks are going to zero, but if you're levered 5 times, 10 times, your stock could go to zero. So just be very mindful that the ice is getting a little thinner for all those on liquidity.
There you go. All right. Well, let's shift gears here real quick. You wrote an article on Wednesday. Again, this has been one of the hot topics, and ironically, right when you produced this article, gold took a 5% clip. But, talking about dollar debasement, and, this is, and it's interesting because you and I are both kind of writing dueling articles. I've been working on one kind of in the background on myths around debasement and those type of things. But let's just, kind of go through what debasement is and what it is not, and kind of go through the article that you wrote. It's on the website now, on the website. So if you go to realinvestmentadvice.com, Mike's article is out yesterday morning, so it's on the website now. You've got that access to it. But it's just talking about this whole narrative that's been put out there in the marketplace, talking about dollar debasement, and is that really what this is? And so Mike kind of digs in the article, kind of the truth behind what's going on. Gives you all the facts and figures. So, Mike, why don't we just kind of go through this? We'll go through some of the charts. Just I've got the charts up on my side, so if you just tell me which chart to show, I'll put that up for you.
Okay. So what I think is really important is not what the definition of debasement is. It's what the market thinks the definition of debasement is. This is a narrative. This narrative is driving precious metals. It's driving speculation to some degree. So it's important for us to understand what the narrative is. The narrative is debasement. Well, what does debasement mean? And it's not a room in your house. Debasement is, according to the market, defined as 3 things. And I've, between reading a bunch of articles, social media, even going to definitions on websites, it's excessive increase in the money supply. It's declining purchasing power and a loss of confidence in the money. That is how the market is defining dollar debasement. And according to the market and a lot of media pundits, that is what's going on. So we can start with, what is the money supply? The Fed, the government, does not print money.
Well, hold on real quick before you go there, because again, you should pull up your article on your side, because again, you've got some really good charts here, and we need to show people. So I kind of want to stay in order of kind of your article, and when you're talking about debasement, in particular, and bring this chart up. This has been a topic of conversation that has been much more just recent, and it's been more recent because of the rise in gold prices. Again, gold prices are going up, so we have to have a reason why gold prices are going up, and that's been fueled by this massive push of debasement articles and theories been written by, all kinds of people put out there. It's like, here's the debasement, this is why this is going on. That's rationalization. That's not reality. And this is an important point that Mike makes in his article, is when you take, this is a chart of all the story counts that are going on with the word debasement in it. And as you can see is that, this has been around over the last, couple of years. Mike and I have written numerous articles over the last couple of years about the fallacy of the debasement, fallacy of the de-dollarization and all these type of things. But just lately, it has become a topic of media clicks and views, right? This is getting, as gold prices are going up, everybody's looking for, why is gold prices going up? Why are gold prices going up? So everybody's writing articles about debasement, which then fuels the psychology for why gold's going up. So now this is why I got to buy gold. And then, that sets you up for potentially that reversion. Anyway, Mike, so laying that out now, go ahead.
No, that's a great point, because the purpose of this article was really to answer that question. Is debasement a reality, or is it just a false narrative? And, narratives can be true or false. So I thought I would just go through those three key things and try to define it.
Right.
So to understand the excessive increase in the money supply, we have to understand where the money supply comes from. The Fed or the government do not print money, no matter what everyone tells you. They do not print money. Now, what they can both do is incentivize money creation. The Fed does it with low rates, with QE, for instance. But if we look at what the Fed's doing, they've run very restrictive policy. The most restrictive we've really been since prior to the 2008 financial crisis. They're doing QT. They're pulling 40 billion of liquidity out of the market. So they are disincentivizing money increases, lending, right? The government's borrowing a ton of money, right? That's the argument. And that's true. And again, money is lent into creation. So when the government borrows money, in theory, indirectly, it's creating money. But what it's doing is restricting the banks from lending money to other people, to corporations. And that's an important fact. So when we look at M2, that's the money supply. That's the most popular gauge of the money supply. What we see and what we want to look at M2 is as a percentage of the economy, not just growth and not just the amount of money in the economy.
Let me stop you right there real quick, because that's such an important point. And particularly this goes along with all of the kind of the commentary in the markets, right? Is that people only look at the rise of M2. It's like, oh, look at M2, it's going up. Well, of course it's going up, because the economy is growing. We're running at 2.5-3% economic growth. So, of course, the money supply is increasing. And what's important, and the point you're about to make, I'm going to turn it back over to you, is that you have to compare money supply to something. You have to compare it to GDP, because it's a function. Money supply is a function of economic growth. Go ahead.
No, and I think this is kind of the money chart, right? The M2 and the economy chart. I assume you have it up?
Yeah, we do.
Okay, and you can see that M2 and GDP are kind of parallel lines. Sometimes they diverge or converge a little bit. And you can see the huge spike that occurred with COVID. But look at where it is now, right? The money supply spiked and then it didn't grow. It actually shrank a little bit. And money supply, M2 as a percentage of GDP, is the same level it's at today that it was in 2016, 2017, right?
Mm-hmm.
So I'm not saying forget about what happened during the pandemic and a couple of years after that, but where we are today, there is no sign of excessive increase in the money supply. It's the same as a percentage of the economy that it was. What people fail to consider is that GDP has risen sharply since the pandemic as well. So, you wouldn't expect the money supply of the USA to be the same of Jamaica, because it's a much smaller economy. So you have to factor in the economy. That's a huge thing that many people just fail to consider. They just look at the graph of the money supply and it's going up, up, and up. The second one is the decline of purchasing power. And I used to buy a movie ticket in the 1950s for 50 cents, right? That's the argument. And now it's 15, 20 bucks. Popcorn is God only knows how much. It's ridiculous, right? But that fails to consider that our wages have increased, that our wealth, our investment wealth, has increased. So look, if you have money in a tin can under your mattress or in a vault, that sucks. Your purchasing power has gone to S, right? It's gone. The 50 cents.
Hey, we're on YouTube. We're on YouTube now. We're not on radio anymore, so you can use those words. So
Brent can always bleep me out later.
Yeah, exactly.
So if you took that 50 cents in 1950, thinking that you'd go to the movies today,
mm-hmm.
the best you could see is one preview for one movie, and then they're going to kick you right out of there.
Right.
Purchasing power has stunk. But if you look at wages on an inflation-adjusted basis, so how have wages done against inflation? They've increased, meaning we're making more. How has wealth done? And for this, I just did a simple graph comparing T-bills to CPI. Your return on T-bills has been greater than the return that you would have had if you just kind of invested in CPI. Your real return has been positive. So even if you're investing in the most safest, less risk product, your returns have beat inflation over the time. Doesn't mean there aren't periods where they don't, but over time, wealth and wages have beat inflation. So this whole purchasing power argument only applies to people with tin cans stacked with money or mattresses that are very uncomfortable because they got all that money under it. Then there's loss of confidence in the currency, right? Just look at a graph of the dollar and pan it out for more than like 9 months. It's down 10, 15% in the last 9 months. Pan out that graph and you'll see it goes up and down 10% all the time. It's almost exactly at its average price from going back to 1970.
Right. And this is such an important chart. Brent, bring that chart back up. This is such an important chart too for people to understand, is that when you're looking at a dollar index, it's how the dollar is trading relative to a basket of other currencies. Its fair value is 100, right? That's its fair value relative to other countries. So if we're trading at a premium to a basket of other currencies, it's going to trade at higher than 100. If we're trading at a discount to other currencies, then it's trading lower than 100. And right now we're trading right around 100, going back to its fair value since 1971. So, again, the dollar index, just because it's declining doesn't mean that, people are getting out of the dollar. In fact, this is my article for next week, is, they're not getting out of the dollar. They're not doing all these other things. It's just simply that the other currencies are just appreciating at a faster rate than the US dollar. That has economic advantages and disadvantages depending on which side of the dollar that you're on. So, and again, this is why you see that when the dollar gets too low relative to another currency and it becomes, and all of a sudden, the Chinese yuan has dropped dramatically relative to the U.S. dollar. The Chinese government steps in and props up their yuan to get it closer to a peg value because U.S. goods become too expensive to buy, and it's an inflation impact to those countries. Vice versa, right? So whether it's imports or exports, the value of the dollar relative to other currencies, whether you're trading in euros or yuan and we're in dollars, whatever that is, the value of that currency imbalance has a big impact on the economies of those countries. And so those countries always work their reserves to try to keep their purchasing power close to the peg, right, the standard of the US dollar, because it's still 60% of all trade. So anyway, go ahead, Mike.
Let's think about this. Many foreign investors, unlike us, a lot of us invest domestically. We buy U.S. stocks, U.S. bonds. We don't really have to think about the dollar. If you're a foreign investor, right, Lance, if we were in Europe and we were doing this show, we would go through the whole spiel about we like stocks, we like bonds, and we would always have to talk about the dollar, because that's another part of the return.
Right.
If you buy a dollar asset and the dollar goes down 10%, but your asset goes up 10%, you've broken even. It doesn't matter if the asset went up 10, you lost 10% on the dollar. So everything foreign investors do is predicated on their view of the dollar. So if we just assume no one has confidence in the currency and that they all think the dollar's going to zero, why is federal debt held by foreign investors at record highs? And actually the pace of growth has increased over the last couple of years. That's kind of odd, isn't it? If you think the dollar's worthless. Equity demand, same thing. Foreigners have been buying equities. That tells you that they don't think the dollar's collapsing. The rest of the world is telling you that the dollar's just fine, that it's not hindering their want or need to buy U.S. Stocks or bonds or whatever they're buying, real estate. So there's one more argument, and this is kind of the fail-safe. If those first three fail, here's what you go to. And it's that the price of gold, right? How do we say gold? It's, what is it now? 4,100 an ounce,
yeah.
$4,100 an ounce. So it's gold is quoted in ounces per dollar, right? And what they'll say is gold isn't rising. It's the dollar that's collapsing. Okay, we can go with that argument. If that argument holds true, then other hard assets, what's the ultimate hard asset? Real estate should be going up because the dollar, the denominator, is collapsing, right? Case-Shiller has been flat to negative for a year or so. Prices are going nowhere for houses. I show a chart of the gold oil ratio. If again, oil should be going to the moon too, and the gold oil ratio should be a flat line because they're both going up significantly together. That's at almost a record high, the gold oil ratio.
Right.
So, it's a nice narrative. It tells a story. The problem is it's just not a real story.
Right, but you've got to but Mike, you're missing the most important story about this is that central banks are just hoarding gold reserves right now.
Yes, I was hoping we didn't have to get to that, but we'll get to that. So there's a bunch of graphs going around that shows that so central banks, we've talked about this before, hold dollars, but they don't really hold dollars. They hold bonds, they hold treasury bills, they can hold stocks, they can hold all kinds of things. Well, rumor has it that they're selling all their stocks and bonds and buying gold. We know that they're not selling all their stocks and bonds, and they're not doing that. We just showed you that graph, but are they buying that much gold? And if you look at a line, I don't have that graph in this article, but it's a significant increase in gold as FX reserves.
Right. There was a recent chart out by Statista that I published on X, and it says that gold reserves by central banks are now greater than their treasury reserves. And that makes complete sense, right? Because the price of gold has gone up and the price of bonds have gone down over the last few years. So again, that makes complete sense. But the question is that's just a function of price, right? Are they actually buying more ounces of gold? And that's the real question. If they're really hoarding gold, that means that they are just accumulating massive amounts of gold itself and putting it into their vaults. Is that being done right now?
No, and they measure, we can get access to this information, and they measure it in tons held by the foreign central banks, and it's increased at about 5% over the last 5 years. That's not annualized. So about 1% a year. So they've very slowly bought. And actually, Lance, what I wanted to do was make a graph the other day when gold was down, whatever it was, 3, 4, 5%, to show you how FX reserves in golds are plummeting, how they're selling everything.
Right. It's a rebasement
because it's
trade.
A function. It's basically a huge portion of that change in gold in FX reserves is price. It's not tonnage. Tonnage is really what you need to be looking at, and that doesn't show any signs that in aggregate they're grossly buying.
Yeah.
It doesn't mean that there are some countries that are buying. There are some countries that are selling.
Yeah.
But in aggregate, there's nothing. There's no story there. And then I end. Look, this all leads to then why is gold going up? And I personally think, I know you do too, Lance, think the answer is speculation.
Sure.
Right? Everything that goes up, the market just gloms onto and wants to buy. It's buying Beyond Meat at $8 a share when it was 50 cents and bankrupt a week ago.
Right.
Right? It's just these cryptocurrencies, altcoins. And the last graph just shows that the call put skew is just so grossly out of whack towards call. So much call volume, it's just unbelievable. If you're really worried about debasement, and if you're worried about these long-term structural issues, you're not buying calls, you're buying gold. And the fact that speculation is running so rampant in these derivative markets for gold is just another clue that what's going on in gold is not sustainable. It doesn't mean gold's not going to zero, but it's just so far out of its range, it's so overbought that it's due for a correction. And that correction, here's the crazy part, Lance. I think it could correct 25 or even 50% and still be in a bullish trend.
Oh yeah.
If you're bullish gold,
yeah.
If you're bullish gold long term, hold on to it. It could be going down to 2,000, but it's still in the bullish trend. If you're bullish gold, but you're not hung up on narratives and this other stuff, sell it. You can buy it back cheaper prices, just like every other asset or every other financial asset. Houses, except for you, Lance, Most of us just hold on to them. But
I
just
think
like
my
we,
wife's going to make me hold on to this last one. I don't think she's going to let me sell it.
right. I mean, like, how many times have we taken profits in some of these magnificent seven stocks that have gone up? We like their stories, but just take some profits, take some money off the table, because they can be overbought, even though the fundamental story makes sense.
Yeah, look, and that's really the key to all of this is that, first of all, let me just be very clear for everybody listening to the show. We're long gold and silver and uranium and other stuff. We have a portfolio that carries that. So we're long these asset classes. We're not poo-pooing these asset classes and saying, oh, we're just bearish gold, you need to get out of gold. We're not saying that at all, right? All we're trying to lay out for you is the reality of the facts that are going on within in the markets. Most of the stuff that you're hearing is just narrative to get clicks and views or to sell you gold, right? The guys that are selling gold are putting out all these articles and the dollar's going to collapse, the world's going into the end game and blah blah blah. You better have gold. Well, let me ask you a question real quick, Mike. This question is for you too. Have you ever seen a zombie movie? Have you ever seen an apocalyptic movie that, and they're all running around bartering with gold? No, you don't. They're just trying to survive, right? So if we get into that environment, it's not going to be gold that saves you, right? If the world economy collapses, it's not going to be gold that saves you, right? You're going to have all other kinds of problems that you're going to have to deal with outside of gold. But so the point is forget all that narrative, right? Just focus on the facts. Are people really selling bonds and getting out of the dollar? No, there's no evidence of that. Are central banks hoarding gold right now because, they're anti-dollar? No evidence of that right now. Now, could that change in the future? Sure. Absolutely, that could change in the future, but there's no evidence of it right now. So as such, and what I find interesting, Mike, is that, people find bubbles in everything, right? Except the asset class that they're in. Oh, there's a bubble in AI stock, so when that blows up, you better be in gold. But they can't see the bubble that's getting created in gold because of sentiment. The bubbles are just a function of sentiment and price. So when price gets too far deviated from long-term means, you're going to have a reversion at some point. And that's all Mike and I are warning you about, is that if you take a look at call option volume on gold, take a look at just overall, kind of leverage in gold. One of the 5X leveraged ETFs that just came out was on gold, on GLD. So again, that is just a sign that speculative fervor has now hit that asset class. And all we're saying is, we're not saying sell this. We're not saying that it's going to crash and go down 50%. It certainly could, just like stocks can, just like every other asset class can. Bitcoin can go down 50% and still be in a bullish trend. The stock market could down 30 to 40% right now, still be in a bullish trend from 2009. We're warning you about, and this is all this conversation is today, is just a suggestion that you may want to apply some risk management to even the asset class you're most fervently bullish on, right? If your thesis is that gold is going to go to the moon and it's because the U.S. economy is going to be in this huge demise, if that's your thesis, that's okay. All we're saying is you might want to consider managing some risk. Because again, you can, and we kind of warned about this last week, said one morning you're going to wake up, market's going to be down 5%. That's going to be your clue. And that can happen. And, you can, and it can take a lot of losses. So all we're just saying is that none of the data supports the narratives. So let's focus on the facts. And that's the most important thing. Mike, go ahead.
No, I agree. I was going to go there. I see a comment that says banks are dumping treasuries.
No.
Well, look at yields. Bond yields have been dropping for the better part of this year, right? We were up at 4 3/4 or so at the beginning of the year. We're at 4%. Our
actually
banks,
below right now.
Right? Actually, we showed that foreign central banks are buying treasuries and at a greater rate than they were. So, it's easy to listen to these stories and to these narratives and get sold. There are some really good salesmen, but those facts are out there. And just look at the facts. And they're very easy to find. The World Bank, the IMF, the Fed, there's a ton of data sources, independent data sources as well, that will tell you exactly what's going on and make your decisions from the facts. not the stories that are being woven to explain why the price is up.
Right. So I don't really understand. Again, there's a lot of comments like, how is the U.S. dollar down 21% over the next 5 years? There's no evidence that the dollar will be down 21% over the next 5 years. There's no evidence of that at all. If the economy grows, which it probably will, you'll see the dollar strengthen relative to its long-term par value. Again, we go back to that chart. The dollar trades around 100. So if the economy is weaker, right, as we have right now, the economy has been weakening over the last couple of years, which is why the dollar has declined over the last 12, 15 months, right? It's been a very normalistic decline. But if you take a look at the dollar, since 2008, it's in a very strong bullish uptrend. So again, why did the dollar collapse during 2008? Because we were in the middle of a financial crisis, right? So if the economy is weak or you're in a recession, the dollar is going to weaken because of the economic change relative to other countries that may have stronger economic growth than we do at the current time. So those currencies will strengthen in value. The dollar will decline in value. If the U.S. economy strengthens, then you're going to see a stronger flow of money into dollars. And that's what you're seeing right now is that, there's expectations of economic growth reaccelerating into next year. So you're starting to see the dollar rally here a bit. You're seeing gold, oil rally here as well. So that's money flowing back into dollars. And here's one of the other problems is that if you believe the dollar is going to weaken, you don't want to own gold because gold trades in dollars. So if you're a foreign investor, and this goes back to Mike's point earlier, if I'm a foreign investor, and let's say that I trade in that my currency is French francs. So I'm in French francs or I'm in the euro, whichever one you want to use, right? So I'm in the euro and I'm a foreign investor and I buy gold. I have to worry about two things, right? Not just the price of gold. I also have to worry about the dollar currency because if gold goes up 10% and the dollar goes down 10%, as Mike said earlier, I just broke even. That's all I did. I didn't make money. So again, the risk of the dollar is simply a function of economic conversions between two countries, and that's just there's not this, and this is why this whole debasement trade is nonsense, because there's no evidence to suggest there's any debasement trade going on at all. The dollar has had a huge. Mike and I were writing articles about dollar debasement back in 2021-ish, Mike, I think it was. And that was when the dollar was under a lot of pressure, and then it had a huge rally, right? And the dollar debasement trade went away, and it was like, okay, well, the dollar's rallying strongly now, and so it got really overbought, and now it's pulling back towards par value. That's all. Just like stocks, when it gets too far ahead of its par value, it's going to revert back to its average long-term value or below its long-term value, and then it's going to rally back to it again. But at the end of the day, the dollar's going to trade around 100 on its index because that's where it's been for the last 50 years. Go ahead, Mike.
And it's kind of funny that the gold price and the narrative were popping up in 2025. The time for this was 2020, 21, 22 a little bit, when the government was being just fiscally and monetarily very irresponsible. They, it's late to the game. As it was in, after 2008, it really started rallying a couple years later before it really, it got cut in half. So again, look, all these facts that we're spouting are out there. You can believe them or not believe them, but they're out there. And, just remember again, it's not just the deficits and the money supply. It's also the economy has grown significantly. So put all the facts together and you can debunk the narrative or not.
Go ahead. You won.
That was it.
Okay.
That's all I had.
You got it? All right. Well, look, there's, this is a very touchy subject for, everybody. And again, we're not trying to, again, I want to make it very clear. We're not anti-gold. We're not anti-stocks. All we are is just discussing risk management. That's all we're talking about here. And what's important about understanding risk and risk management is to make sure that you're working with facts, not narratives. And just because somebody tells you that, China's dumping all their U.S. Treasuries, that's not really the case. Now, do they change the amount of treasuries that they hold from time to time in order to balance their reserves, their U.S. reserves, to keep the U.S. dollar peg closer to their currency? Yes, that happens all the time. Sometimes they sell bonds, sometimes they buy bonds. Same thing with gold, same thing with actual just U.S. dollar exchanges. It's a function of economic demand. It's a function of keeping currencies somewhat in balance because that affects the economic outcomes of these countries. So it's important to dispel the narratives so that you understand the risk that you're taking with certain asset classes. And then when things get too far ahead of themselves, just a good reminder to take profits and rebalance risk. Again, I just, to clarify, we have portfolios that are long precious metals, and we took profits out of those gains because we had massive gains. We rebalanced those portfolios about a week and a half, 2 weeks ago. So again, that's just a function of good portfolio management. And that's all we're encouraging you to do is set aside the narratives and just focus on the facts at hand and then focus on the risks that you're taking in your portfolios. That's it. No more, no less. All right. That wraps up the show for the day. I hope you liked it. Be sure and like and subscribe to the channel. We appreciate it very much. Certainly helps us. And again, Mike's article is on the website. So if you want the data for yourself, just go to the website, realinvestmentadvice.com, click on the article about gold and dollar debasement. That's on the website now, realinvestmentadvice.com. And again, like and subscribe to the channel. That really helps us a whole lot, and we do very much appreciate it. We'll see you back here tomorrow for Financial Fitness Friday. Have a great week.